Hello, friends, investors, and fellow survivors of the financial matrix. Welcome back to Boss Economic World, where we strip away the jargon, ignore the mainstream media fluff, and look at the naked, shivering truth of the global economy. Today is Tuesday, December 16th, 2025. You can smell it in the air, can't you? No, not the mulled wine and the roasting chestnuts. It's the smell of desperation. It's the smell of a central bank realizing it has held the brake pedal down for about 6 months too long, and now the engine is stalling in the middle of the highway. We have breaking data out of the UK today, fresh off the press from the Office for National Statistics. And let me tell you, if you were hoping for a soft landing, you might want to check your parachute, because the ground is coming up very fast. Unemployment is up. Wages are cooling. And the Bank of England, our dear friends in the ivory tower on Threadneedle Street, are currently sweating through their bespoke suits. Why? Because on Thursday, they have a decision to make. Do they cut interest rates and save Christmas? Or do they hold the line and risk turning a recession into a depression? The market thinks it's a done deal. I'm here to tell you why this is the most dangerous sure thing in recent history. Let's peel back the layers of this economic onion and see why it's making everyone cry. Let's look at the scoreboard. The ONS dropped a bomb this morning. The UK unemployment rate has climbed to 5.1% for the 3 months through October. Now, for those of you who don't memorize historical spreadsheets for fun, let me put that in context. That is the highest level of unemployment in nearly 5 years. We are talking about levels we haven't seen since the bad old days of the post-pandemic reshuffle. We are up 0.1 percentage points from the previous period. Oh, boss, I hear you say, 0.1% doesn't sound like a lot. Friends, in the world of macroeconomics, trends matter more than absolute numbers. This isn't a blip, it's a trend line that is pointing strictly northeast. We have broken the psychological 5% barrier. That is the threshold where labor market cooling stops being a policy goal and starts being a political crisis. But wait, it gets worse. The ONS also released tax data for November. This is the real-time stuff, the data that doesn't lie because it comes straight from the payroll software. The number of employees on payrolls fell by 38,000. Think about that. In a single month, the month before the biggest retail season of the year, 38,000 people lost their paychecks. That is a stadium full of people. That is 38,000 households tightening their belts, canceling holidays, and switching from Waitrose to Aldi, or from Aldi to the food bank. This confirms what we have been warning about on this channel for the entirety of 2025, the lag effect is real, and it is brutal. Remember back in 2023 and 2024 when the Bank of England hiked rates to the moon to fight inflation? Milton Friedman, the grandfather of monetary theory, told us that monetary policy operates with long and variable lags. Well, the lag is over. The bill has arrived. Companies held on to workers as long as they could, what we called labor hoarding, because they were scarred by the shortages of 2022. But now? The cost of debt is too high, demand is softening, and the hoarding is over. The shedding has begun. Now, let's look at the other side of the coin, wages. The data shows that wage growth has edged down to 4.6%, dropping from 4.7%. If you listen to the mainstream news tonight, they will spin this as a victory. Wage growth slows. Inflation pressure eases. Huzzah! But here is the cynical truth, 4.6% wage growth is still historically high. It is still well above the 2% inflation target comfort zone. However, the trajectory is down. The wage price spiral that boogeyman the central bankers used to scare us with is dead. It's been strangled by high interest rates. Why does this matter? Because the Bank of England has been terrified that if they cut rates too early, wages would explode again. This data tells them that the workers have lost their bargaining power. When unemployment hits 5.1% and you see your colleagues getting fired, you don't walk into the boss's office demanding a 10% raise. You keep your head down and pray you're not next. That fear? That discipline? That is exactly what the central bank wanted. They engineered this. They broke the labor market to fix the currency. And now, they are looking at the wreckage and saying, okay, maybe we can stop beating the patient now. So, here we are. It is December 16th, 2025. The Bank of England meets on Thursday. The market has priced in a nearly 90% probability of a quarter-point rate cut. This would take the bank rate down to 3.75%. Now, 3.75% is still restrictive, but it's a lot better than where we were. It's a psychological gift. It's the bank saying, we see you, we hear you, please don't stop buying houses. But here is where it gets interesting. Bloomberg conducted a survey of top economists. You know, the guys who wear bow ties and predict the past very accurately. Their consensus? They expect a tight 5-4 decision in favor of a cut. 5-4. That is a razor-thin margin. That is a split jury. Why the hesitation? Because inside the Monetary Policy Committee, there is a civil war happening. On one side, you have the doves. They are looking at the 5.1% unemployment, the minus 38,000 payrolls, and the flatlining GDP, and they are screaming, cut. Cut now before we crash the economy. They know that if the UK enters 2026 with high rates and rising unemployment, the recession will be nasty. On the other side, you have the hawks. These are the inflation trauma survivors. They are looking at that 4.6% wage growth and saying, it's still too high. If we cut now, inflation will come back like a zombie in a horror movie. They are terrified of being the central bank that cut too early and let the inflation genie back out of the bottle. This 5-4 split tells you everything you need to know about the state of the UK economy in late 2025. It is balanced on a knife edge. Let's analyze the narrative. Why are we talking about a pre-Christmas cut? The Bank of England skipped a move in September. They skipped a move in November. They sat on their hands while the data deteriorated. Why? Because they wanted confirmation. Well, congratulations, Andrew Bailey. You got your confirmation. You got 38,000 lost jobs. Are you happy now? The reality is, central banks are like large oil tankers. They take forever to turn. They waited until the iceberg was visibly scratching the paint before spinning the wheel. A cut to 3.75% on Thursday isn't stimulus. Do not mistake this for the money printer go BRRR days of 2020. This is removing restriction. This is taking the boot off the throat of the economy just slightly, so the patient can gasp for air. Mortgage rates are already pricing this in. If the bow doesn't cut on Thursday, if the hawks win that vote, markets will riot. The pound might spike, but the FTSE will crater, and gilt yields will fly up. It would be a disaster. The bow has backed itself into a corner where it must cut, not because the data is perfect, but because the alternative is a financial panic. Now, I want to address the professionals in the audience, the asset managers, the traders, the CFOs watching this. The narrative for 2026 is shifting. We spent 2024 worrying about sticky inflation. We spent the first half of 2025 hoping for immaculate disinflation. Now, we are staring at stagflation light. Growth is stalling. The latest GDP figures were anemic. Productivity in the UK is still a disaster. And yet, because of structural issues, Brexit trade friction, energy transition costs, and aging workforce, wage pressures remain sticky even as unemployment rises. This is the nightmare scenario for a central bank. If you cut rates to fix unemployment, you fuel inflation. If you raise rates to kill inflation, you explode unemployment. The bow is choosing the lesser of two evils. They are choosing to tolerate slightly higher inflation to prevent a total collapse of the labor market. They are pivoting from inflation fighters to recession dodgers. So, enough with the macro theory. What does this mean for you, the viewer? 1. If you are a borrower, the relief is coming, but it will be slow. A cut to 3.75% helps, but mortgage rates aren't going back to 1% or 2%. Those days are gone. If you are on a variable rate, you'll get a small Christmas present. If you are looking to fix, the banks have likely already priced this cut in. Don't expect a massive drop in mortgage offers next week. 2. If you are a saver, the party is winding down. Lock in those high-yield fixed bonds now if you haven't already. The trajectory for cash returns is down. The risk-free rate is dropping. 3. If you are an investor, this is the tricky part. Usually, rate cuts are good for stocks. But why are they cutting? They are cutting because the economy is getting sick. Bad news is only good news for the stock market for a short time. Eventually, earnings matter. If people are losing jobs, they aren't buying iPhones, new cars, or subscriptions. Be careful with consumer discretionary stocks. 4. If you are an employee, the power dynamic has shifted. 5.1% unemployment means the great resignation is truly over. Job security is now more valuable than a speculative pay jump. If you have a stable gig, hold on to it. The labor market in early 2026 is going to be cold. We have to look at this globally. The US Federal Reserve has already moved. They started cutting earlier because they saw the signs. Europe is in the doldrums. The UK is, as usual, the awkward middle child. The UK has higher inflation stickiness than the US, but weaker growth. We are in a more fragile position. If the bow cuts to 3.75% while the Fed continues its path, the interest rate differential shifts. This impacts the pound. A weaker pound makes imports more expensive, which, you guessed it, increases inflation. It is a vicious cycle. The bow is walking a tightrope in a hurricane. The Bloomberg survey expecting a 5-4 vote is telling you that the experts are just as confused as the layman. There is no consensus because the data is contradictory. Unemployment says cut, wages say wait. But in the game of chicken between the central bank and the economy always wins eventually. The economy has slammed the brakes. The bow has to follow suit. To wrap this up, Tuesday's data was the smoking gun. Unemployment, 5.1%. Payrolls, minus 38,000. Wage growth, 4.6%. This is the final hurdle. The Bank of England has run out of excuses. They cannot look at a labor market shedding nearly 40,000 jobs in a month and say we need to remain restrictive. That would be economic malpractice. So, prepare for a rate cut on Thursday. It will be framed as a victory. Bailey will go on TV and say, we have tamed inflation. But you, the smart viewers of Boss Economic World, know the truth. They aren't cutting because they won. They are cutting because the economy is starting to lose. They are cutting to stop the bleeding. This isn't a celebration, it's triage. The era of higher for longer is officially dead. Welcome to the era of lower because broken. Keep your powder dry, watch the vote count on Thursday, and don't believe the hype. The real economic challenge isn't inflation anymore, it's growth. And right now, the UK growth engine is sputtering. I'll be back on Thursday to livestream the Bow decision and analyze the fallout. Until then, keep your eyes on the data, and don't let the big bosses pull the wool over your eyes. Sign off. If you found this analysis useful, smash the like button, it helps the algorithm find more truth seekers. Subscribe if you want to survive 2026 with your portfolio intact. I'm the boss. Class dismissed.